Hello traders, welcome back to Nova channel. As you can see now, gold prices have set a new all-time high at $35.06, reflecting strong and sustained upward momentum, bolstered by a convergence of multiple macroeconomic factors. The current rally is not merely a short-term price surge, but has more structural natural compared to previous cycles, thanks to a shift in global central banks' reverse policies. And today's topic provides a comprehensive analysis combining fundamental and technical factors to build a professional trading strategy. In a context where there's no historical resistance, the strategy for maximizing profit will focus on identifying new price targets using the Fibonacci extension tool and capitalizing on healthy pullbacks to enter trades in the direction of the trend. Mastering the EMA ribbon system based on Fibonacci sequence will be the key to identifying high probability buy on dips opportunities. Concurrently, applying advanced risk management techniques such as volatility-based positioning sizing and strategic stop-loss placement is crucial for capital reservation in a volatile market. And now we will move on to the first part of today's topic, historical context, gold in the macroeconomic view. Gold's price reaching $35.06 on the international market marks a significant milestone, but to fully understand its meaning, it must be placed in a historical context. This price is considerably higher than the historical peaks recorded in previous bull cycles. Specifically, during the 1970s rally, gold increased from $35 to $850, an extraordinary 23-29% gain. The 2000s bull cycle also saw gold price from $300 to $1,900, a 533% increase. Compared to previous price surges, the current rally has distinct characteristics. Gold has consistently demonstrated its role as a safe haven asset during global economic crises. However, the current price rally is not only driven by cyclical factors, but also by a stronger structural shift. A key difference in the current rally lies in the structural change in gold demand. Data analysis shows that this price surge is supported by a more sustainable factor, gold purchases by global central banks. These banks are actively diversifying their reserves away from a dependence on the USD, which is under threat from record U.S. government debt and geopolitical risks related to economic sanctions. This demand from the official sectors has absorbed a significant portion of the gold supply on the market, creating a sustainable upward price pressure even when demand from retail or institutional investors does not increase proportionally. This creates a solid price floor, significantly reducing the risk of a deep decline, like those seen after a speculative peak. This analysis suggests that the current price peak is not just a short-term speculative high, but a level supported by the stronger macroeconomic factors, solidifying the long-term outlook for precious metal. And the below table is gold comparison with historical market situations. And now we will move to the next part of today's topic, analysis of key fundamental factors at play. In addition to structural momentum from central banks, gold prices are supported by several other fundamental factors. And first, we'll talk about Federal Reserve monetary policy. The relationship between Fed monetary policy and gold price is one of the most crucial drivers. Gold is a non-yielding asset, so when interest rates rise, the opportunity cost of holding gold increases, reducing its appeal compared to income-generating assets like bonds. Conversely, when the Fed is expected to cut interest rates, this opportunity cost decreases, boosting demand for gold. Key economic data, especially labor market and inflation reports, can cause significant volatility and change expectations for the Fed policy. And second factors we were talking about is inflation, real yields, and the inverse relationship. The relationship between gold and inflation is not always simple. While gold is seen as the hedge against inflation, it reacts more strongly to real yields, calculated as the nominal interest rate minus the inflation rate. When the real yields are negative, like inflation is higher than interest rates, income-generating assets lose their real purchasing power, making gold extremely attractive. This difference explains why gold can increase in value even when nominal interest rates are high if the markets expect inflation to rise faster than rates, thereby reducing real yields. And the third fundamental factors that we will talk about today's topic is geopolitical impact and safe haven demand. Gold has a traditional role as a safe haven asset during times of uncertainty and risk. Recent geopolitical tensions, including trade disputes and armed conflicts, have boosted the demand for a precious metal. For example, uncertainty over trade tariffs with the U.S. has supported gold price. Similarly, the lack of progress in the peace talks between Russia and Ukraine has also increased the demand for gold as a safe asset. And now we will move on to the next important part of today's topic, relating to technical analysis and trading strategy after a new peak. Firstly, let's analyze the new price peak, breakout or false breakout. Based on the chart provided, the price of gold is at $34.95, just a few points away from the news peak of $35.06. Traders often ask whether this is a successful breakout or false breakout. A successful breakout is confirmed when the price returns to retest the new support level, which was previously resistant, and rebounds to continue the trend. In contrast, a false breakout, also known as a fakeout, occurs when the price breaks the level but quickly loses momentum and returns to its previous trading range. In a strong uptrend, gold prices reaching a new peak are often accompanied by overbought signals from momentum indicators like the RSI and stochastics. However, in a strong bull trend, these overbought signals are not a reason to sell off. Instead, they indicate that the market is overheated and need a healthy correction to ease pressure and build a stronger foundation for the next leg up. This correction will create a second entry opportunity with a higher probability of success, leveraging the principle of a confirmed successful breakout. And now we will learn about how to determine profit targets, Fibonacci extensions. When gold price sets a new peak, identifying profit targets become challenging because there are no historical resistance levels. In this case, the Fibonacci extension tool is a useful solution for projecting the next price targets based on the previous price waves. The most common Fibonacci extension levels used as the price target includes 127.2%. This is often the first take profits for many traders as it balances risk and reward. When the price breaks this level decisively, it can signal a further increase. And the second level we need to concern is 161.8%. This level represents the golden ratio and is considered the most important target in strong trending markets. And lastly, we can concern about 200% and 261.8%. These levels are considered more ambitious targets, typically reached only during powerful and prolonged rallies supported by sustained market drivers. To increase the reliability of these price targets, the principle of confluence should be used. A Fibonacci extension targets become more powerful when it aligns with around price level, like $3,600 or $3,800. High volume trading zones or momentum signals from the RSI. This combination provides traders with more reliable signal for making decisions and managing position. And the below table is a gold price target scenario using Fibonacci extension for your reference. And now, let's move on to the next part, advanced application for the EMA 34, 89, and 200 system. And I believe that this system is very familiar to you because I introduced with you how to install it every single time I have live stream on YouTube. The EMA ribbon system, based on the Fibonacci sequence, is a powerful tool for identifying and following a trend. The EMAs used include 34, 89, and 200, with each playing a specific role. EMA 34 and 89, these two lines represent the medium-term trend and act like a dynamic support level in an uptrend. When the price pulls back to this line, they often create ideal entry points. EMA 200, this is the most important moving average. Consider the boundary between long-term bull and bear markets. In a strong uptrend, the EMA lines will be stacked in order from the shortest to longest, and spades evenly apart. This parallel and spade arrangement is a strong signal that the trend is sustainable. Traders should take advantage of a buy on dip strategy by waiting for the price to retest the EMA 34 or 89 lines and look for confirmation signals from candlesticks or other indicators. When the EMA rebounds or intertwines, it's a sign of trend weakness or a sideways market, and it's a time to avoid trading. And now I will move to the next part that help you to protect your capital. That is risk management and optimal trading skill. First, we'll talking about how to position sizing in a high volatility environment. Position sizing is the most critical factor for protecting an account, especially in a high volatility market after reaching a new peak. Instead of relying on a single method, or a hybrid position sizing strategy can be most effective. And we cannot forget about the 1% rule. You should not risk more than 1% of your total trading capital on a single trade. This rule ensures that even with a string of losses, your account remains protected. And second, volatility-based model. Let's use the average yield range, which is usually called ATH indicators, to adjust your trade size based on the market's actual volatility. When gold becomes more volatile, the trade size should be reduced to keep the risk fixed, and vice versa. The combination of these two methods allows the trader adhere to a strict risk management rule, not risking more than 1% of capital, while being flexible enough to adjust the trade size changing market conditions. And now, this is the second part of today's article, strategic stop loss and take profit. Placing stop loss and take profits order strategically is essential for optimizing profits, as always. And the first, strategic stop loss placement, and the meaning of stop loss order should not be placed randomly. Instead, it should be placed below significant support levels, such as the previous breakout price or below the dynamic EMA lines, which helps minimize the chance of the ordering being triggered by small price fluctuations. And second, using a trailing stop. This is an effective tool for locking in profits in a strong trend. As the price moves in your favor, the stop loss order automatically moves with it, but it stays in place if the price reverses, helping to secure profits already made. And lastly, is a partial profit taking. An effective risk and profit management strategy is to take a partial profit at the first Fibonacci extension targets and let the rest of the profit run with a trailing stop. This ensures that you have secure profits while still have the opportunity to earn more if the trend continues. And the below tables is a comprehensive risk management guide for you to refer. The analysis shows that gold prices are supported by sustainable fundamental factors, indicating the potential for a continued uptrend. Recoveries from healthy pullbacks can create high probability trading opportunities. Instead of trying to short a strong trend, the optimal strategy is look for entry points when the price corrects to dynamic support zones, which are identified by the EMA lines. And I hope today's video will provide you a useful information for your gold trading in the future. Happy trading and see you in the next video.